For Sidus Space, ticker SIDU, there technically wasn't an official Wall Street consensus to beat or miss this quarter.
Right, mostly because only one analyst actually covers the stock right now.
Yeah, but the actual numbers, I mean, they paint a pretty stark picture right out of the gate. Revenue plummeted 54% year over year, down to just $583,000.
Wow, just over 500,000.
Yeah. EPS came in at -6 cents. The net loss did narrow slightly to $4.8 million. But for guidance, well, management offered zero numeric targets.
None at all.
Nothing. They instead pointed to early 2027 for the initial commercial availability of their Fortis VPX platform.
And, well, the market reacted pretty violently to that. Shares closed the regular session up slightly at $2.60, but then they just tanked 9.62% in after-hours trading.
Ouch. Dropping down to what, $2.35?
Exactly. But, that volatility makes sense when you look at the fundamental pivot happening inside the business.
Right, so let's look at why revenue just got sliced in half. Think of a company that used to make, I don't know, metal bolts for airplanes.
Like a low-margin legacy business.
Exactly. Now they're stopping production on those bolts entirely so they can build their own proprietary high-margin drones.
And obviously you don't make bolt money while you're building the drone factory.
Right. Sidus is intentionally walking away from their legacy-related party contract manufacturing.
Which, by the way, drops 75% in the first half of the year.
Yeah, so they are sacrificing that legacy manufacturing to pivot toward high-margin space as a service.
Meaning they are focusing resources on their LizzieSat satellites and their Orlaith AI edge computing technology. Because instead of beaming all that raw data back to Earth to process it.
Which takes a massive amount of time and bandwidth, right?
Yeah, exactly. Edge computing lets the satellite process the data right there in orbit. I mean, it's a much more valuable service for their defense and commercial clients.
But building out that kind of infrastructure in orbit is not cheap. You really see the cost of that transition in their margins.
Yeah, you do. While their gross loss actually narrowed to $630,000, which is a positive step, their adjusted EBITDA loss widened to $5.1 million.
Right, and that widening operating loss is largely driven by a 19% spike in SG&A expenses.
Because building new space infrastructure requires hiring expensive engineers, carrying heavy overhead while you're waiting for the tech to launch.
Right. Yet, despite those heavy operating losses, the balance sheet was completely transformed. Sidus is now sitting on a massive $166.5 million in cash.
And they carry zero debt.
Okay, wait, I have to push back on that math. How does a company generating $500,000 in quarterly revenue suddenly amass $166 million in pure cash?
It doesn't.
Right, that doesn't happen organically through operations.
No, and that brings us to the massive catch for retail investors. They raise that cash through direct stock offerings.
Ah, I see.
Yeah, essentially printing millions of new shares to sell for cash. Shares outstanding surged 54.8%.
Wow.
Jumping to a total of 101.1 million shares.
So they bought themselves a $166 million runway, but because the company pie is now cut into 101 million slices instead of 65 million, the existing retail investor slice is suddenly worth a lot less.
Yeah, exactly. Management commentary did address that operational reality head-on, though. They highlighted some real progress. Their next LizzieSat just cleared vibration testing.
Right, and defense primes are actively evaluating their tech.
Yeah, but they openly acknowledge they are crossing what they call the valley of death. They are entirely relying on this newly raised cash to survive until they can actually scale commercially in 2027.
So retail investors are kind of stuck holding a heavily diluted bag while they wait for 2027.
Well, there is an invisible buyer stepping in, though. Sidus was recently added to the Russell 2000 and 3000 indexes.
Oh, interesting.
Yeah, so that forces those specific index funds to automatically buy the stock so they can accurately track the index.
That actually leaves you with a fascinating macro question as you watch this transition unfold. I mean, now that Sidus has dramatically expanded its share float to raise that $166 million, will the passive institutional buying required by these index funds be enough to absorb the massive retail dilution?
Right, or is this just a classic microcap dilution trap?
Yeah, exactly. Definitely something to keep an eye on. Make sure to follow the show for your daily earnings coverage.